Good afternoon. Have you ever wondered just how much money an advisor makes when they sell you an annuity? Let's talk about that in the next video. Welcome, folks, to Wealth and Whiskey, where every discussion is aged and unfiltered. Today, we're going to unfilter some stuff. I'm Roger Kiger. I've been a financial advisor for about 30 years, helping people build wealth and protect their legacies. So this channel is about looking behind the scenes a little, and today we're going to talk about some things that'll likely get a few advisors a little upset with me, but if it prevents you from making a bad decision, or at the very least making a decision that is from being completely informed about all your options, then we've made a lot of progress. So that's the goal today. So really, in the topic for today's discussion, we probably won't get through all of it because there's a lot, right? But we're going to talk about the different types of financial advisors, because I'm going to break it into 4 different categories. Maybe we'll get through the first couple today. We'll see how that goes. When we're talking about the different types of financial advisors, let me clarify that by saying there's not really a regulation that says you even have to be licensed to be a financial advisor. I know, seems a little criminal, right? But financial advisors could be people that help you manage your credit card debt. They could help you with a mortgage. Almost anybody can call themselves a financial advisor, which is a little bit of the problem here. But for our purposes, we're going to talk about people that have a specific type of license, which is what governs how they do investments. Okay? And let's start by breaking that into 4 categories. The first one is going to be insurance. The second one is going to be commission-based financial advisors. The third is fee-based financial advisors. And the fourth is more wealth management or financial planners. Right? So we'll go through all 4 of those in a fair amount of detail, but I'm going to try not to put everybody to sleep, because that I can do for sure. So let's talk about number 1, the insurance-based financial advisor. So what does that mean, right? So it means that, in full disclosure, I have this license, right? So it means that with an insurance license, I can sell a life insurance policy or a fixed annuity or something that's called a fixed indexed annuity. Those are all insurance-based investment products, frankly. They're just products. So they're most common if somebody has a specific need for a specific dollar amount for a specific time period. They're generally based for more conservative clients, somebody that needs to make a little bit more than you're making on that CD at the bank, but you want your principal guaranteed and you want some fixed interest rate guaranteed for some time period. Okay, nothing wrong with them. They're fine. The indexed annuities, what's called a fixed indexed annuity, is a fixed account that indexes the performance of that to some stock market based performance. So you can typically make a little higher return if the markets do well in an indexed annuity, and your principal is guaranteed. Pretty good investment, really. Why wouldn't you do that? Well, so let's talk about the pros and cons of the insurance-based financial advisor, which again requires an insurance license. So the pros are the rate's usually guaranteed on a fixed account. The principal is guaranteed on a fixed and an indexed account. But the downside is on the indexed account, you could walk away with really making little or nothing, but your principal is guaranteed. The downside is that a lot of financial advisors sell that as a stock market based investment, when really it's up to the insurance company to assign some value to your account at the end of some time period to credit you with some higher interest rate based on the stock market. It's not invested in the stock or the bond market. It's just not. It's an account invested directly with the insurance company, and they're buying options based on the performance of some stock market index, which is how they can give you a higher performance, more so than a fixed account. But it's just not going to be as much as you would earn in the stock market had you invested directly in the markets. So I know that's confusing, but that's an index-based annuity that gives you, maybe it's 10% of the stock market returns. So if the stock market goes up 15%, you go up 1.5. So you can see where it's not a lot of performance. Those are evolving, they're changing, and there's always some different catch where they're going to call some other kind of thing call it some name. It's really, really cool, but yes, you can participate in the stock market with some upside performance, and there's generally a guarantee your principal. Great. We should all go do those because there's no risk. And to be fair, depending on the market conditions, everything else that's going on, they are right for some people. They're just not right for everybody. So what's the downside? Well, the downside is they always have some surrender period, which means you have to stay invested in that product for 5 to 7 years on average. They're all different, but that's the average, right? So if you want your money out, you got to pay a surrender charge to get your money out. The downside is when you ask what the fee is, there's no fee. Well, if there's no fee, why would they do it? What's in it for the insurance company and for the advisor? I'm going to tell you, knowing I might get in a little trouble with some of the advisors that I work with, right? When they say there's no fee, but there's a surrender charge, there is a direct correlation to the surrender charge in that investment and the commission the advisor makes. So if it's a 7-year surrender charge, the advisor is probably going to make the term of that surrender less 1 in a commission. They're probably going to make a 6% commission. So put that in dollars. If you put in $100,000, the advisor is going to make a $5,000, $6,000, $7,000 commission on a $100,000 investment. So when they say there's no fee, there's a fee in there somewhere. It's baked into the insurance company or the annuity company, and they might call it an S&P index, whatever. It's still an account held at an insurance company. The insurance company is going to make their money on it somehow. They're going to pay that commission to the advisor up front. So the insurance company's out that money if you pull your money out before some time period, hence the surrender charge. They want their commissions back that they've already paid to the advisor, which is generally why there's a surrender charge on an investment like that. Now, are they bad investments? Not necessarily. Again, it depends on what they're for. So, if you're looking for some investment for a dedicated time period, and the advisor is going to say, well, this is a long-term investment, you need to stay invested, there is still a charge if you change it. If you know the time period, whether it's 3, 5, 7, up to 10 years. I've seen them as long as 15 years. I don't know why anybody would tie their money up for 15 years, but on average, they're 5 to 7 years. Maybe it's okay if you're going to make some 5% rate for 5 years in today's market conditions. May not be so bad to get a guaranteed 5% rate with no risk to your principal. It's a fixed account with the insurance company. Just make sure it's a good, creditable insurance company that's got a good credit rating. And those investments are great for somebody that's a little more conservative and just wants to know what they're going to make, not take risk with their principal, but want to make a little bit more than they would make in a CD. Okay, so that's the life insurance-based financial advisor that has to have a life insurance to sell that type of product. And they can also sell life insurance types of investments, permanent, term, all the different type of life insurance products. So pretty common. I would say there are probably a lot more of those types of advisors in our industry than there are a lot of the other types of advisors, which are commission-based and fee-based. Okay, so that's the first one. The second one will be a whole lot quicker, is essentially a commission-based financial advisor. Well, what does that mean? And to if this helps or not, a commission-based financial advisor has to have a series license, which is called a Series 6 or a Series 7. Well, so who cares, right? Well, the Series 6 or Series 7 gives them the license to sell an investment that is directly invested in the stock or bond market or some other market, whether it's commodities or, Bitcoins or whatever. But they have to be licensed with those types of license to do those types of investments. Now, okay, great. We can do that. If they're selling a mutual fund that has either an upfront commission or some deferred surrender charge where you don't see the money come out up front, but there's a higher fee, and they've fronted the commission back to the advisor. Remember we talked about this. That's why there's a surrender charge. So why would you do that instead of just buying, an index online somewhere, right? Well, for some people that have a small amount of money, that want to get started and want to talk to somebody about picking the right fund, all right? And if you want to just put some money in an account, we call that the set it and forget it types of accounts, which is it's not uncommon for people that are getting started in the industry. What's the benefit to that? If somebody's putting in $100 a month or $250 a month, and they pay $5 to the advisor a month each time they do that to get a little advice along the way, maybe that's okay, right? It's probably not as common as the insurance-based financial advisor, but that commission side is starting. The people that do it with those licenses are getting smaller and smaller because you as the investor, the consumer is starting to figure this out, that maybe they don't need to pay a commission for stuff they can figure out online, do on their own, or let AI help them with. Why would they pay that commission to the advisor? With all that being said, it's not necessarily a bad investment. It falls under what the SEC calls a suitability risk, which means the advisor has to do what is suitable for you as a consumer based on what you said you were looking for. And as long as it's the commission paid to them is suitable regarding the investment, that's okay. So those are most commonly used for variable annuities, which it's an insurance-based product that is invested in a stock market-based account. So why would you do that? Why would you do that, right? Just buy it outside the VA. Well, the variable annuities give you some things like tax deferral. So if it's not IRA money, you still want it tax deferred, you can use a variable annuity for that. So you're still investing in the market and getting it tax deferred. Some variable annuities, they don't guarantee your principal, but they'll guarantee some income for you for the rest of your life. So there are some scenarios where those products are great to solve a specific need. If it's just a general investment type of account, the variable annuities tend to be quite a bit more expensive than what you really need for a long-term type of account. And again, when a commission-based advisor says it's a long-term, when you put it in the stock market, it needs to be invested for the long-term, don't worry about the surrender charge. I'm going to tend to disagree a little. You should always worry about the surrender charge. Remember what I told you about the surrender charges? Yeah, those relate to the commission that the advisor can make. Again, I'm licensed to do that as well. I've done all these, and I keep all these licenses so I can service those types of accounts if they come to me. But it's just not a type of business that I've done much of in the last 15 years. Because the downside is, they get really expensive. They are hard to get out of. It's hard to change that investment. If your situation changes, if the stock market situation changes, if the economy changes, and let's be honest, life's difficult enough, things change. We need the flexibility to make some of those adjustments. So I know it sounds like I'm talking negatively about those first two types of investments, which are the insurance-based investments, which require an insurance license, or the commission-based investments, which require a Series 6 or Series 7 license. They're not bad investments. They're probably the most common. There are more of those types of investments than anything else. And those are the way the investment world has done this for decades. It's the foundational type of investment for a lot of large banks and wirehouses. When you go buy an investment, it might be commission-based. They may not ever tell you, but I promise you it's in the paperwork that you sign somewhere. They're probably going to disclose it somewhere. Ask the right questions. Ask how your advisor is getting paid. They got to tell you that. And you shouldn't be embarrassed to ask these kinds of questions. And at the end of the day, if it doesn't feel right, don't do it, right? Just don't do it. Talk to more advisors until you get comfortable with who you're talking to and the type of scenario they are presenting for you. So 3 and 4, we'll save those for another time. The third is the fee-based advisor, and the fourth is basically a wealth manager or an asset or a financial planner that will relate back to some of these asset management types of investments. So I would categorize insurance and commission-based advisors as asset management type accounts because they're selling you an investment of some type. So we're going to wrap it up with there. I hope that's helpful a little bit about some of these insurance-based folks, some of the commission-based advisors, which you're very likely to find at a bank or even some of the big brokerage firms. These are all names that you know and would recognize if I told you. Those are still fairly common types of investments. You need to ask those questions, okay? So we'll wrap it up there for today, and we'll talk about the fee-based and the financial planner or wealth management types of advisors in the next video of the series. And then we'll wrap it up with a video that talks about comparing asset management to wealth management and what is that difference, okay? So for that, just remember that financial success isn't easy. It's slow, and it's earned by diligence and patience. So to start your journey, download our Legacy Blueprint below, and don't forget to like and share these videos for the Wealth and Whiskey channel. So please stay tuned, stay plugged into the next videos because we don't want you to miss any of these conversations. I'm Roger Kiger. Your time's really important, and I appreciate you spending it with me here on the Wealth and Whiskey channel. Cheers. Okay. Cheers.